Good evening, all of you. Uh, Thank you so much for joining today on a Tuesday evening for this talk on mergers and acquisitions, perspectives from the US. We are very blessed to have Mr. Bobby Achettu here with us for the talk. Thank you so much, sir, for agreeing to do this. And can we have a loud round of applause for our facilitator of the evening? Um, I have a very distinguished bio with me to quickly give you a quick glimpse about all that he has done in the field of finance. So he's basically the founder and CEO of Accelerated Growth, which is called as AG. And before founding AG, Bobby was serving in several leadership roles, including at the Chicago-based private equity firms and within the strategy and consulting practice of PwC, which is PricewaterhouseCoopers. Bobby is also a director on 4 corporate boards of companies ranging in size from $3 million to $50 million in revenues annually. And he sits on 2 nonprofit boards, including as the co-chair of the Employer Advisory Board within the Northwestern University Weinberg College of Arts and Sciences. As an adjunct professor at both the Northwestern and the Loyola universities, Bobby teaches on the evolution of modern business and social entrepreneurship. He is currently the incoming president of the Chicago chapter of the Entrepreneurs Organization, very widely known as EO, and will begin his term in July 2022. So, of course, best wishes to you, sir, for the upcoming term as the chapter president of the EO, and we look forward to having a perspective on mergers and acquisitions. So as a quick format, what we'll be doing is we'll give the floor to Bobby. He'll take you through a presentation of about good 20-30 minutes, after which we'll open the floor. We hopefully will have some questions from all of you, and we'll give a take on that after your presentation, right? But before that, I have a small formality to do as I welcome him with a small rose and a quick memento. So please allow me to do that, as I expect a quick round of applause again. Thank you so much.
Great, thank you. Thank you so much. Thank you, appreciate it. Excellent. Well, thank you, Jahel. Again, I appreciate it. And I had the opportunity to learn first about the Ahmedabad Management Association a couple of years ago when we opened up our offices here. And in fact, last December, I had the opportunity to speak here, and it was supposed to be in person, but unfortunately that trip got canceled, so I did a virtual session. So it's an absolute honor to be here finally in person after these last few months. Now, just by a show of hands, I want to understand this audience a little bit. Just raise your hand if you're here to get out of the heat today, and that's the only reason you're here. Can you raise your hand? No. So it is pretty hot today, and I've heard later on this week it's going to get even warmer. But what I could tell you is something else that's very hot. What's very hot in the United States is mergers and acquisitions. It's almost as hot as the Ahmedabad weather. And there's a couple reasons for this. First and foremost, there's a tremendous amount of capital that is available in the United States that has not been deployed. And when you look at economic times of uncertainty, you look back to 2008. It was a very different environment in 2008. Though there was uncertainty in the economy, there was not much capital to be deployed. And so what's happening in the United States is there's economic uncertainty, at the same time there's capital, and then all of a sudden what's happening is any organization in the entrepreneurial world that is actually performing well is getting many, many offers to be acquired. So I'm going to talk about all of this over the course of the next 20 minutes here. But before I do, just want to go a little further back into my story, my personal story and my professional story. So I was actually born in Kerala, came to the United States when I was 4 years old. My parents have the typical immigrant story. Came to this country with very little, worked their way up, got jobs, and frankly, the vast majority of my early career, I had not anticipated at all to start my own company. In fact, like many immigrants, the thought was work at a large organization and that will provide you safety. And so that's what I did for the first dozen years of my career. I worked at large organizations. Grew up in Kottayam, came to the United States, Spent 12 years in large corporate organizations, most recently with PwC, where I worked in their turnaround and restructuring group. So that was an interesting opportunity for me because, as I said, most of my life, my parents had encouraged me to work at large organizations because of the perceived safety of those large organizations. Well, at PwC, working in turnaround and restructuring, very often we went into organizations that were in distress. So these are multi-billion-dollar organizations that were challenged for various reasons. So specifically, I'll give you an example of a bank that we worked with, a bank based out of the East Coast that was losing about $100 million a month. And so their board called us in and said, we have to restructure this organization, and we did. And the first thing we did is we looked at the people of the organization, the number of headcount per department, their compensation. And what I realized very quickly is, though there's a perceived safety in large organizations, the reality is in a situation like this, sometimes you just become a name and a number on a spreadsheet. And that changed my perspective of safety. And what I realized later on in my career is working within entrepreneurial organizations, actually, though there's a perceived risk because the companies are smaller, you can make yourself invaluable. You can create a scenario where you're one of few people in the organization that have outsized impact, and you can make yourself irreplaceable. And I learned that lesson while working at PwC, the risk associated with working in large organizations, and for that reason, I made the jump into a private equity firm. And this was really my first exposure to the entrepreneurial space, and I fell in love immediately. The passion, the vision, the ability to have an impact. I fell in love with the work and the environment. What I didn't love was the culture of that organization. I went from being part of a 200,000 person global organization in PwC to working within a 6-person business. And though I loved the small business environment, that particular private equity firm, like a lot of firms, were so focused on money that it was really a turnoff. I got into that entrepreneurial space to work with founders and feed off the energy of those founders. And so ultimately, I decided to start my own company in accelerated growth. The first few years, it was me and a couple independent contractors. You could hardly call it a business. It was actually my first exposure to working within India. Obviously, I'd been born in India and having family there. Every couple of years, we would go visit. But when I first started Accelerated Growth, our first client was an entity that had operations in Coimbatore. And so at the time when we started with them, they had about 30 or 40 employees in total between the US and India. In a 3-year period, they grew to about 500 people. So it was my first exposure to working within India from a business perspective and then seeing the associated scale. And so obviously now at this point, we've built offices in India. We have offices in both Bangalore and Ahmedabad. And so I'm really excited to be able to finally come back on a consistent basis. So I have not been in India for 2 years, whereas prior to that, every 6 months I would come to visit, not just to visit the offices, but really to come back home, quite frankly. So over the years, we've worked with 300 plus companies in multiple different industries. And I'm going to share some experiences with mergers and acquisitions in these industries. And what you'll find is, as we all know, every industry is different. The valuations are different. The risks are different. And so we'll talk a little bit about that. So again, over 300 companies, multiple different industries. We do a lot of work within CPG, so consumer products goods, software as a service, distribution, e-commerce, those types of things. I also have been teaching for the last 7 years. So at Northwestern for 7 years, and then Loyola actually just recently over the last year, I've been teaching a social entrepreneurship class. So what's been interesting about that is, in addition to my professional work experience, merging that with some of the academic frameworks that I've seen within M&A and elsewhere has been really fascinating. So I'll share some of those thoughts with you. So M&A in the US. So amazingly, global M&A topped $5 trillion in 2021. So let's talk about that a little bit and what happened over the course of the last couple of years. So going into 2019, and really the end of 2019, there was certainly an uptick relative to prior years, but it was not a huge uptick. So if you look at 2018 and 2017 M&A activity, it was fairly consistent. Then 2020, as all of us remember, March of 2020, when COVID really hit. And I say that because obviously COVID was around many months prior, but the world global stoppage occurred really in March of 2020. And in fact, I have an interesting story related to that. I'm part of this entrepreneurs group that was mentioned earlier, and there was a conference in Iceland. So the first week of March, we had this conference that was scheduled for the second week of March. And so it had been planned many months in advance. And so myself and a group of 8 other individuals that were going to this conference from Chicago were on a conference call, and we decided, you know what, we're going to go ahead and with this trip because we didn't quite understand what was going to happen with COVID, right? So we get on a plane, we land in Iceland, and within 12 hours, President Trump announces the travel ban. So we literally got online immediately, booked our tickets, and came back. So I spent 16 hours in Iceland. So I'm looking forward to finally going back at some point. But an interesting story to start my COVID journey. And what I can tell you is, from the moment that I landed in Chicago from Iceland, it was nonstop, absolutely nonstop. So at that time, we probably had about 60 clients. And those 60 clients, first and foremost, they wanted to understand what their financial viability was over the next several years. Really, several months, but focused on next several years. They needed to make it through the next several months to get to the next several years, in fact. And so we got calls nonstop. And we have an interesting business model for a scenario like this, in that most of our engagements are fixed fee, monthly recurring type work. And so when a client calls you in the middle of at the start, I should say, of a global pandemic and says, listen, I need you to go over scope. I need you to create forecasts and models and make assumptions around where our business is going to go. It's challenging because when you're in a fixed fee contractual relationship, how do you tell them, you know what, you have to pay us extra for it? And so we didn't. And so those were probably 3 of the busiest months in accelerated growth history. Every single person in the firm surged to provide the support to our clients that they needed to help them navigate these tumultuous times. So those 3 months, effectively what happened is we worked more without getting paid anymore from our clients. And then of course, from a recruiting perspective, just like everywhere in the world, nobody was hiring because nobody knew what was going to happen. So how can you hire people? So if you think about, we had a tremendous additional workload. We didn't hire any additional people. Our team really dug in. We were in the trenches with our clients, and we really helped them get through the planning process related to COVID. Now, we were very fortunate, and as I look back, I like to think it was strategic, but like a lot of things in life, they just happen naturally. We, as a business, do a lot of work in consumer product goods. So as we know, during COVID, what happened was a lot of industries like retail, like restaurant, tourism, those industries suffered. But there were other industries like CPG, e-commerce, distribution, software as a service that did really, really well. So going into COVID for those 3 months, every business in the country, if not the world, stagnated. Everyone was trying to figure out what was going on. So the first month it was absolute, just frozen, nothing happened. The second and third month trying to recover and figure things out. Well, then, starting in about June, the tides turned, and they turned very quickly. All of a sudden, there was this incredible boom of activity in every industry that was positively influenced by COVID. Again, CPG, e-commerce, distribution. Now, during those 3 months that COVID hit and froze everything, M&A froze as well too. And it was super unfortunate because we had several clients that were in the midst of transactions, $100 million transactions that got frozen by COVID. And so these were founders, investors, leadership teams that were just at the finish line. In fact, we have one client where closing was 2 days prior to Trump's announcement. And I use Trump's announcement in the US as the start of COVID because that's when people started to realize that this was real. Even prior to that, again, I was part of a group that was in flight to Iceland because we weren't actually sure what was going on, that it would be that serious. So for that 3-month period, March, April, May, all M&A activity froze. There was literally no firms that were doing deals. Then in June, everyone started coming out on the warpath, but something was different. Something was different. Only the best companies out there we're getting funding. And that's not always the case. And we all know that is in many instances, there's organizations out there that are smoke and mirrors, right? Scenarios where they're not profitable and they're operated off of a PowerPoint presentation as opposed to business fundamentals. So what happened from June of 2020 through the end of the year was you did not get funding unless you had some strong financial and operational performance. So it was no longer about PowerPoint presentations and future forecasts. It was about actual financial and operational performance. And that was shocking to a lot of people. In fact, to some of our clients. The vast majority of our clients are what I'll call in the second stage of growth. So they're not startups. So they're typically about 20 to 50 million in revenue. And so at that point where they're really at that scale. So to put it in perspective, they're more in the Series A and B round as opposed to venture rounds, right? Most of the work that we do is with private equity as opposed to venture capital. And just by a show of hands, who knows the difference between private equity and venture capital? So a couple people? Okay, so I'll go through that real quick. So private equity venture capital is part of a class of investments that are just traditionally riskier than other investments. So if you think about a bond as an example, right? A government-backed bond as one side of the equation of risk, typically private equity will be on the other side, right? And so what does that mean is the expected returns on private equity may be upwards of 10 to 20%. So for every situation a private equity firm engages in, what they're looking to do is they won't invest unless they're getting at least a 10x return on the transaction. So they put $1 in, they're looking for at least $10. And the reason they're looking for $10 is because there's many instances where they are going to fail. 30 to 40% of the time, their investments would fail. That's private equity, okay? Venture capital may actually be looking for a 20x return because they're investing in many more entities and they're expecting to fail even more. So if you think about the individuals that run these firms, and I was part of a private equity firm at one point, they have to be in a position to quickly assess the viability of a business. They have to. And what happened in the last 2/3 of 2020 is all the projections, all the forecasts got set aside. It was about business fundamentals. It became very difficult as an entrepreneur looking to scale an early stage business to find funding. Then something shifted in 2021. What shifted is, as a private equity or venture capitalist, one of the things that you have to do is you're obligated to actually deploy the capital that you're given. You can't just hold on to it, okay? So let me take a step back again because I think some of you are not as familiar with the industry, right? So private equity and venture capital as an asset class is a much riskier investment generally. The expected returns are higher. So let's say I'm a high net worth individual and what's your name up front? I'm sorry? Muncie. Okay, excellent. So let's say Muncie is a venture capitalist and I'm a high net worth individual. And I've made investments in real estate, I've made investments in the stock market, but I want higher returns. What I do, let's say my net worth is $100 million. What I'll do is take that $100 million and I'll break it out into different asset classes as I invest. Because I don't want to be over leveraged into real estate. I don't want to be over leveraged into the stock market. And each of those different asset classes will provide different returns, different expected returns. So your real estate investment might provide you a 5% return. Your investment in the stock market, let's say you just do a general index fund. So an index fund is something that just flows with the market. Maybe that's 7% return. But I want some of my assets to be invested in riskier and thus higher return investments. And so I'll go in and invest with you on private equity. So my expectation is that you're going to provide me with a 12 to 20% return. So let's say I decide to take of my $100 million, $10 million and give it to you. So I need to make that return. I'm sitting here as an investor and I need to make that return. Now, until you deploy it, you keep that cash in just some interest-bearing account. So maybe you get half a percentage point or a tenth of a percentage point. So let's take that fact, right? That's how the industry works, right? So I give you money And you have to then deploy it and invest it in companies you believe are going to grow. I give you that money. Now here we are, I just said, from April of 2020 through the end of 2020, we're in a situation where private equity is too scared to invest. They're only going to invest in situations that they know for sure are going to work. And by the way, in the entrepreneurial environment, a high growth environment, there aren't that many times in certain industries where companies are actually profitable. It's amazing, and we see so many businesses that are built off their balance sheets, making sure they have enough cash to burn, right? So for a 9-month period, private equity firms are on the sideline with their capital, waiting to find deals. Well, what happens after that 9-month period? And remember, I say 9 months because after the end of the year is when, and I'm sorry, what was your name again? Muncie. Okay, I apologize. When Muncie has to produce her reporting to me to say how my investment has done, right? So Muncie sends me a report in January of 2021, and I'm sitting in my mansion, right? And I'm thinking, all right, I'm going to see 20% return. That's what Muncie pitched. When she put up her presentation and said, this is why you should invest in me, she said 20%. And I get a report that says I got 0.1%, which is what I could have done if I went down the street to a bank. And then what happens? I call Muncie and I say, Muncie, you better go spend my money and make me some money. So then what does Muncie do all of 2021? Muncie is looking for deals. She's looking everywhere. She's looking in academia, she's looking in corporate venture, she's looking at her current portfolio of companies and looking at who their vendors and their partners are. And all of a sudden, deal activity starts to increase. And by the way, during this time, you got to remember, near the end of 2020 is when the vaccines in the US started to roll out. So there was a general sentiment around positivity within the economy. And so Muncie starts deploying. But here's what happens, right, is there's still a limited number of deals that have financial viability, right? Because the reality is there's a percentage. And what I would say is I'm not going to talk, I wouldn't say it's a majority of companies in the entrepreneurial space that are not financially viable. What I would say is there is a subset of I'll say the sexiest companies out there often are burning cash, right? And so Muncie's looking at deals, and there's much more competition for these deals. Much more competition. So just like I called my private equity firm and the lead investor and I said, listen, you need to deploy my capital, every other high net worth individual did the same. They did the same. And so all of a sudden, you have all these investors that are flooding the market looking to deploy their capital aggressively. And we've gotten past the early stages of COVID where there was a fear and a frozenness about what's going on. So then what happens? Think about a scenario where there's more demand than there is product. What happens in that scenario? I'm sorry? Average leads. So average leads, but then also prices go up, right? Prices go up. So in that situation, in the private equity world, what that means is valuations go up. So starting in the mid of 2021, I started seeing some things I'd never imagined I'd see. The numbers being thrown out for some of the companies that we were working with, along with some of the people that I know in the community. So with the relationships I have in the community, the investors, the entrepreneurs, the academics, I just know a lot of people. And so I started having conversations. And so we were seeing some really unusual things. And I think one story that I'll share with you that just still boggles my mind. We're working with a company, software as a service business. Really interesting business with a social entrepreneurship, social good component to it. Now, here's the thing. For those of you familiar with software as a service, they traditionally, depending on what the industry is, if it's a pure software play, which is what this was, they can get upwards of a 10 to 12 times revenue valuation, right? So basically, if it's $1 million business, you potentially get 10 to 12 times revenue. That has to be a pure software play. So if there's any component of human interaction in there, that number goes down. So again, keep that in mind, 10 to 12 times revenue. So this particular business was about $1.1 million in revenue, okay? 1.1 million. That was a again, really sexy business. They were losing a little bit of money, but they were close to profitability. 1.1 million in revenue. One of their angel investors was someone named Serena Williams, which those of you familiar with tennis, very popular, right? And so there were some big name investors that had written small checks into this company. We started working with them to get them ready for capital raise, right? And so they brought us in to do the financial projections, to look through diligence and get them diligence ready, as they call it. So basically, what does diligence ready mean? Diligence ready means that you get the organization to a point where once they raise capital and a sophisticated investor comes in, that you go through a checklist of activities, and what I'll call it is corporate hygiene. They're ready to take on investment. If your financials are a mess, your operations are a mess, your contracts are a mess, no investor is going to actually, they'll give you a term sheet and say, hey, I want to do research and diligence on you, but they won't actually give you the money, right? And so we were engaged to get them investor ready. So we started digging in, understanding the business. Well, at the same time, the investors started knocking on the door, okay? And again, remember that 10 to 12 times revenue number. They ended up raising a Series B round at $120 million valuation, okay? This is a business that did 1.1 million in revenue. Now, of course, they had forecasts and projections that said they were going to be on hyper growth, but you are literally talking about a almost 100 times multiple on revenue. Now, let's go back to the scenario where I invest some money into a company that's valued at 100 times revenue. What's amazing is talking to the founders, we told them, do not take on this capital. Do not take on this capital at this valuation. Because the challenge is, when they get out of this environment that was obviously accelerated valuations, they have to find a way to achieve that valuation under normal circumstances. So if the normal circumstance is 10 to 12 times revenue, and they take on capital at over 100 million in revenue, they have to fill that gap. And the only way to fill that gap is to substantially increase revenue in a short amount of time. And so now if you think about this, they're not actually taking over $100 million in cash. They're taking in cash at a valuation of 100 million. It's a big difference. So they need to make sure whatever capital they take in is going to last them the amount of time it takes to get to that revenue and valuation threshold. And so as you could hear me describe this, it's a very complex balancing game. And so the phrase that I always use in valuation scenarios, especially when they're up and down as they have been the last couple years, is everything in life eventually regresses to the mean. So it's a statistics concept, right? Is that yes, there are huge ups and downs often that happen in life in all parts of our lives, right? Personally and professionally. But eventually, as you settle back and you look 10 years later, what you'll see is things regress to the mean. And the mean may change slightly, but that valuation, there's a reason that there's a 10 times, 12 times revenue multiple on software as a services business, right? And if you look at, as an example, services businesses. Services businesses traditionally trade at anywhere from 5 to 8 times multiple of profit, okay? Let's think about the difference and the distinction there. For a services business, it's people-based. And so when you look at that profitability, the way you really look at that business is based on how that model is executed, how many years of profit can be generated. So a company at scale, so call it 25 to 50 million and above, will typically trade at 5 to 8. That's typical. What we're seeing in services businesses is anywhere from 8 to 12 times right now. And again, it has to do with the fact that there's so much competition to get deals. There's so much capital out there that hasn't been deployed. Now again, software as a service is very different. Software as a service, in many instances, there's a recurring revenue model that allows for consistency of expected revenue over a longer period of time. For a services business, you may have a year contract, but that contract could go away if your people go away and aren't able to execute. However, a services business, software business, you could end up with that product engaging a client for 5 or 10 years, right? So again, let me take a step back because I know I'm covering a lot of things in the year 2020 and 21. First 3 months of COVID, March, April, May, everything freezes. No transactions happen. In fact, investors back out of those transactions. The next 6 months takes us to the end of the year, and only the best deals are getting funded because the investors are sitting on the sidelines and saying, unless I know that this company is going to be successful, I'm not going to invest. And all of a sudden, it reaches the end of the year, and high net worth individuals and institutional investors. So again, the vast majority of capital deployed, I use the example here of a high net worth individual. The vast majority of capital deployed is going to be from Goldman Sachs, Fidelity Investments, some of these big players. That's 90% of the capital out there. They call their private equity firms and venture capital firms in January and they say, what the heck is going on? How come my returns are so low? If you don't deploy this capital, I'm taking my money back. What do the private equity and venture investors say? You know what? We're going to deploy your capital because we don't want you to take your money back. So all of 2021, immediately valuations start to increase. So in 2021, we told just about every one of our clients, if you haven't in the past thought about selling, you should think about selling. You may not get these valuations ever again. Now 2022, that deal volume has, sorry, and I'm going a little bit off slide, so I apologize, but the US deal market accounted in 2021 for 2.9 million of it. So this is where I was going. Labor shortages. That's another interesting component that was happening in 2021. So as we know, the last several years, there's been labor shortages overall. So there's a lot of M&A transactions that are being driven by what are called acqui-hires. So has anyone heard of this concept, acqui-hire? No? Okay. So acqui-hire is the combination of the word acquisition and hiring, right? So essentially it's a scenario where you acquire companies just to get their people because it's so hard to actually hire people on your own, right? So lots of different factors driving to what happened in 2021 with the increased activity, increased valuations related to M&A, and that continues in 2022. In fact, if anything, M&A is expected to grow substantially over the next year. And there's some underlying factors as to why that is. A, there's still a ton of capital out there, a tremendous amount of capital that hasn't been deployed. B, there is still a limited amount of deals. The reality is the good businesses out there, there was a reset that happened during COVID. What I would say is on a percentage basis, let's say there's about 30% of deals that were just not fundamentally sound, but people were investing in because they thought it was an interesting company because Venus Williams invested in and all those types of things. Those 30% of the deals are not getting funding anymore. They won't anymore in the future because the market has just gotten more sophisticated. So the subset of deal flow has decreased, and so therefore valuations have increased. The money is still out there. Now inflation is occurring substantially in the US. We're at about 8.5 or 8.9%. So that obviously will have a factor on deal activity in the upcoming years. But from everything I'm seeing from the investors and advisors that I'm talking to, the deal flow and the deal activity is projected to continue at least this way through the end of the year. On this slide, I just have some notes just about the outbound capital being deployed and the inbound capital. So roughly about 500 billion was invested outside of the United States, and the US received 430 billion, and this is from 2021, I believe. So again, lots of investment happening in and out of the US. So I shared one story about the software as a service business. Another story I'll share with you was actually a pre-COVID story. This is a consumer products business based in Chicago. And I remember this company very distinctly because we had started working with them in probably about 2015. So the organization was just founded at that point. They were probably about a 2 million revenue company, founded by two really good childhood friends. And basically they had a concept for a protein bar that was just better for you and tasted better. And so interestingly, when we started engaging with them, we were very much in the early days. So to the point where two of the founders would knock on doors at local gyms and try to create brand awareness. And so ultimately they started scaling and they started growing. When we got to them, they were 3 people, so the 2 founders and 1 employee. Within a couple of years, they had crossed the 50 million revenue marker, which in the consumer products good industry is a real milestone point. Because traditionally in that industry, once you get to that point, that's when you really start to kick off solid margins. And I say that because within consumer product goods, the challenge is distribution. So between retail and e-commerce and all these different channels, the mix becomes really difficult. So they get to this $50 million marker, and now strategics start looking at them. Financial buyers start looking at them. And just to take a moment to delineate the difference between strategic buyers and financial buyers. So strategic buyer is someone that's looking at your organization from the lens of when they acquire you, it's much more than just the profit perspective, okay? That there's something more than profit. So it could be a scenario where you have a product that they don't have the ability to build. You're in a geography that they're not within, okay? Now, pause that thought for a second and let's go to financial buyer. Financial buyer is a lot easier to understand and explain. A financial buyer is someone that's simply looking at your financial statements and they're trying to understand what profit they would be able to derive from you in a given year and the projection of the go-forward profit. So let's just use round numbers. If they look at your company and they say, listen, there's $1 million in profit this year, and we're projecting that that million will stay stable over the course of several years. In many industries, the valuation you would get would be roughly 5, maybe 3 to 5 to 7 times that profit number. Because most people, when they make an investment, they expect a return within that time frame, 3 to 7 years, let's call it. So that's why from a financial buyer's perspective, they're going to look at that profitability for the year and just multiply it out. That's how they're going to calculate things. Now, it's a great way to make an acquisition, but it's not necessarily a great way to sell your company. Because what happens from a financial buyer is they're not necessarily valuing some of the intangibles that you've built, right? Now, again, let's go back to a strategic buyer. A strategic buyer looks at the fact that you're in a particular geography. So as an example, company based in Chicago, but they're looking to acquire a company in New York City, the biggest city in the United States. High rates, right? Because there's certainly things cost more in New York than they do in Chicago. Great distribution channels and networks. Access to Europe. So the company looks at that strategic nature of being in New York City, and the acquirer says, you know what, I'll pay slightly more than that. It won't be 100% more, it won't even be 50% more. But potentially you get 10% higher valuation because of New York. So what we advocate for the clients that we work with is we say, listen, absolutely get your profitability down right. You have to. You have to be at a point where you're at least matching, if not exceeding, the industry metrics. So within services businesses, as an example, traditionally for services business, your goal is 10 to 12%. Now, if you have operations in India, in Philippines, things like that, there might be an expectation of 15 or 17%. If you're an industry that's highly commoditized, so again, if you think about like payroll processing, if you're a US-based payroll processing company, your margin may be closer to 8% as a target. But think about a range of 8 to 15% as what you would expect for a services business. So if you're looking to sell your company, you better be at that range to start off with, because that's going to be the starting point of the conversation. Then what you should be thinking about doing is adding strategic variables that make you even more attractive to strategic buyers. So perhaps you open up in a new geography. You look at specialization in an industry that isn't as competitive. You look at potentially a technology solution that other companies don't have. These are all reasons a strategic buyer would look at you and pay more for your organization. Now, I mention all this because in 2021, all this went out the window in many instances. And what happened is private equity and venture investors were so actively looking for deals they were willing to pay whatever it took to close the deal because they wanted to go back to their investors and ensure that they've at least deployed their capital. What I'd advocate for is no matter what happens over the course of the next year, we have to take a step back and really go back to the fundamentals because private equity and venture will regress to the mean. It's going to happen. And so therefore, I go back to the story I told you about the CPG company. So this company's at 50 million. They start getting suitors. And these suitors are venture capitalists that are looking to make a strategic investment. And in many venture capital scenarios, these investment firms don't always take a majority position. Sometimes they do, sometimes they don't. And so in those situations, they're looking to inject capital to grow the company, right? So they got offers from venture capital firms looking to make strategic investments to help them grow the company, all the way to strategic buyers that wanted to buy the whole thing, buy them out. And so essentially, this company went into what's called a bake-off. So a bake-off is just as you imagine, you get several cooks in a kitchen that are baking a cake, and the founders got to sit there and eat the different cake and decide which cake they wanted to eat, right? And so that's what happened. This entity got 7 different offers from various different type organizations, from venture capital to strategic buyers. And at the time, they ended up selling, and by the way, during this time, in the year and a half that it took to complete this bake-off, they grew from 50 million to 125 million. So they grew substantially during this time as well. They ended up selling for $600 million. So 5 times revenue multiple during that transaction. And it was actually one of the most compelling stories that I've been a part of because of just the chaos associated with that deal. So imagine having your life's work being assessed by 7 different entities while simultaneously almost tripling the revenue of a company in 18 months. So just the chaos associated with that was absolutely unbelievable. The other side of it, which was interesting, is these 2 founders were individuals that they were 28 when the transaction got completed. So think about that, 28 years old when the transaction got completed. And early on in their careers, when they started this company, they had no money, literally. Like didn't know what they were gonna eat. They barely could pay rent. And then you go from that situation all the way to a situation where they sold the company for $600 million. Between the 2 of them, they owned 80% of the business. So effectively, over $500 million was their money, right? Almost $500 million was their money, and they walk away with that type of cash, right? And so we've been fortunate as an organization to be part of several of those types of transactions, see the ups and downs. What I can tell you for go forward, both in the United States and overall, is we don't see this level of deal activity diminishing. If anything, we see it increasing in the upcoming years. We do see valuations in the next 18 to 24 months start to decrease. But for the next 18 to 24 months, we actually see a potential slight increase in valuations. Again, after about 18 to 24 months, they will start to decrease because it's just not sustainable. Some of the numbers being thrown out there from a valuation perspective are just not rational. They're not reasonable. There's no way a software as a service business that generates $1.1 million is worth over $100 million. It just doesn't make financial sense, right? So with that, again, I started out earlier in the presentation just saying, I want to make sure that this is interactive. I've got a lot of stories to share. I could probably sit here, for those of you that know me, and I'm happy to talk all evening, but I would love to take questions and see what other guidance and direction that I can give on this topic. So any questions? I knew you were here to get out of the hot weather. I knew it. I had a feeling. Let's see. Oh, I had some slides on M&A in India as well too, which obviously you're all aware. M&A in India has increased substantially as well. Different dynamic there too, and we don't have a ton of experience with transactions in India. We've done a couple deals with investors that are based in India, investing in US businesses. But again, very similar vein of what I said happening in the US also occurred in India as well. So similar themes, probably to a lesser extent in India than in the US. And then what does it mean for us? As I mentioned earlier, being prepared for diligence is absolutely critical. So if you have an organization or working within an organization, at this time, really being in a position where you're prepared for diligence is critical. What we advise for the clients that we work with is start talking to your competitors. Find out what they're seeing, what they're hearing, understand what's happening in the marketplace, because it's critical for you to understand from a competitive landscape what's happening in the space. Have scripted conversations with investors. We tell all of our clients, do not shy away from an investor conversation. Ultimately, at minimum, on the spectrum of what you can gain from the conversation, at minimum, you'll get educated. You'll get educated in what's happening with valuations. You'll get educated on what's happening with technology innovation. You'll get educated on what's happening with hiring and retention in your industry. That's the minimum. And at maximum, you may end up getting a great valuation for your company. Now, I mentioned in both these instances being scripted, because the reality is you don't want to be out there talking about your company with loose lips. You don't want to be revealing information that could be used by your competitors. You don't want to be in a scenario where you're talking to all the investors and they're starting to think, well, does this guy or girl know what do they know what they want? You have to be very structured in these conversations. And then lastly, and I think most importantly, is stay focused on the core business. This is what we advise. And so you think the example I gave you, the reason I gave that example of the company that was at 50 million when they started looking and they ended at 125 million and got a 5x revenue multiple, they were able to stay focused on their core business. So they almost tripled their business during this time of going through diligence. That's not easy to do, but in fact, one of the biggest risks of going through a transaction is actually getting distracted by that transaction. There is no deal that takes less than 60 days. That's probably the fastest deal that I've ever seen close. And the reality is if you close anything faster than that, there's probably something really good happening or really bad happening. If there's an extreme happening, that again, if it's really bad, that's not good for you, right? But if it's really good, obviously that's a great scenario. And I say really good because as an example, we worked on a deal right as COVID, we're getting out of the COVID chaos of March, April, and May. So we worked on a deal that was closing in August. And this particular company is a really interesting business. It's an organization, and this is public information, an organization called QB. So what QB does is it's the under-the-seat elliptical machine. So imagine you're sitting at your laptop and you want to just get some exercise, keep the blood flowing. So it's a little bicycle underneath your desk is the easiest way to describe it. So during COVID, just like every other organization, their revenue got hampered, their deal flow got hampered, and so for a 3-month period, QB was just unsure what was going to happen. But then starting in June, all of a sudden, they saw their revenue increase substantially. Why? Because that's when people realized nobody's going back to work anytime soon. In April and May, there was still this thought that maybe people would go back to work, and so people were just kind of waiting to see what was going to happen. But starting in June, the whole world realized nobody's going back to work, and so they thought it'd be good to get some exercise while I'm sitting at my desk, in my house, working on my laptop, and all of a sudden, revenue of QB just boomed. And so the investor that was working on this deal, and I remember distinctly having calls and texts from the CEO on weekends, evenings, everywhere, because the investors were just all on top of him. Let's close, let's close, let's close. And the CEO was like, listen, the longer I wait to close this deal, the more money I'm going to make, because revenue was just piling on, just $1 million after $1 million every single month, right? And ultimately what I advised him was, listen, get the deal closed. There's a saying in M&A, venture, private equity, time kills all deals. You don't know what's going to happen. So ultimately, though he wanted to slow down the transaction, I said, if they want to move fast, just make sure they pay a premium. Make sure they're paying for where you would be 2 or 3 months down the line. As long as you check the box there, don't wait for 6 months down the line to close this deal, because you absolutely don't know what could happen 6 months down the line. And this was before we were talking about the variance and the subvariance and all those types of things, but now we know, ultimately you don't know what's going to happen 3 months down the line. So yeah, don't get distracted. That was really the big takeaway there. Questions, thoughts, ideas? Sure, Ambika.
So as a seller perspective, as a company, when we look at the valuation, definitely they want to get the good profitability when they have the conversations on acquisition. But considering the cash crunch they would be having and they are managing their working capital, what are the measures they can take in order to have the deal like strategy buyer as well as a mixture of finance buyer to attract them?
Yep. And so can you repeat the part about the cash piece? I just want to make
Yes.
sure I understand that.
So they are having already a cash crunch because of that revenue flow is on average.
Yep.
It's not below, but it's playing around average.
Yep.
So in that case, what are the key factors for them to look at to boost the cash as well as to attract the both strategic buyers as well as the financial buyers?
Financial buyers. Love it. Love it. So it's an interesting question because first and foremost, it goes back to business fundamentals. So outside of being acquired or taking on investor capital, you have to make sure that your business is operating fundamentally sound. And I think that was one of the things that pre-COVID was often missing.
Yes.
Pre-COVID, you can raise capital by just having a good PowerPoint presentation. You could raise capital and still be taking losses, no problem. That changed very dramatically after COVID. And again, it became a scenario where only the well-operated companies, for 9 months, only the well-operated companies were actually getting investor capital, right? And so I go back to outside of even taking on capital or selling, it's critical that a company have their cash flow managed, that they've got the right amount of working capital. And so in the scenario you described where there's an organization that it sounds like you're describing where they're just getting by, they're slightly profitable, there's just enough cash, the first thing I would advise is to find a banking relationship, right? So on the spectrum of capital, as we think about it, on one side of the equation, actually let's go all the way to one side of the equation. One side of the equation is going to your mom and dad for money. That's probably the safest way. I would not advise it for a lot of different reasons, but that's the safest way. And you think about it, I'm using an extreme example, but that's where there's the least amount of governance for the money that you receive, right? Other than seeing them at the holidays, and many of us talk to our parents every day, so that could be an issue. So I'd have to explain every day what's going on. But outside of that, and again, I'm joking here, but friends and family is what that's called, right? Taking a round from friends and family. That's the least complex from a governance perspective. All the way to a venture capital investor where they're going to want monthly financial reporting, they're going to want a board seat, they're going to want purview into strategic guidance and key hires and all those types of things. What we always advise is start with the least governance. Start in scenarios where people will give you the least pushback and get into your business the least. Because I mentioned here in the last slide is don't be distracted. The last thing you want running your business is people that don't know your business necessarily, the day-to-day of your business, poking and prodding, right? So I'd start with some level of, if you're going to do a capital raise, friends and family. But even before that, honestly, is I'd look at a bank, just a traditional bank. Now, the challenge with the bank is, though there's very little governance, they're very risk averse as well. So you have to be profitable. So in the scenario that you mentioned, if the company's not profitable, they're going to have substantial assets to be able to collateralize. So does everyone understand collateralization generally?
Yes.
Right? Yeah. So basically, you're putting up a certain asset if you don't pay back your loan, right? So there's a lot of variables on that end of the spectrum, but I would certainly start with the least governance and then work your way up. But more than anything else, before a strategic or financial acquisition, you've got to get all that in order.
And the last question is, down the line, since the market is stabilized now, of course there's an uncertainty again still lies. Other than software industries or the regular restaurant industries, if we take, or product-based industries which were not doing well during COVID, do we see a good spike in there in M&A down the line,
Sure.
other than the ones which are already doing well?
Yeah, no, great question. I think that's hard to tell, right? Because if I knew, I would be out there investing in all of these things, right? So, but certainly what I would say is consumer product goods will continue to do well. Software will continue to do well. Tourism and hospitality and all those things are popping back. In fact, what we saw, so we work with we do some strategic advisory work with a company that they do hotel rehabilitation. So it's called hotel rehabs. So essentially in that scenario, what happens is each of these brands, and I'm not quite sure if this is the case in India, but I suspect it's exactly the same. I don't have any data to prove this out. But for most of the major brands in the US, they force each location to do a refresh every 5 years. So if you own a hotel, for example, a Marriott hotel, every 5 years, you're forced to do a rehab. And those rehabs can be millions of dollars, right? And so we worked on actually a really good friend of mine, so we ended up just giving some advisory guidance. And we built a model, okay? And the model was fascinating because most construction businesses, there isn't necessarily a recurring revenue associated with it. So if you think about, if you build a house, generally you're gonna try to live in that house for at least 10 years. And if you built it, you may be planning to live there for 20 or 30 years. And most people are not buying multiple houses. So that particular industry, you're not necessarily a traditional construction business is traditionally gonna be valued just based on profit. Now this business that my friend had was focused specifically on hotel rehabs. So effectively every 5 years, if he did a good job, the hotel that he rehabbed would come back to him. So much more traditional recurring revenue business, right? And so the reason I bring this up to your question is that particular business did extremely well during COVID, because what happened was when hospitality was down and people were not in the hotels, all these major brands said, you know what, people are not in the hotels, let's start rehabbing. So, and that's going to continue for the next year. Like these construction projects are 6 months to 9 months long. So he ended up closing a bunch of these deals, and his business went from about 25 million to it should clear close to $100 million next year. Because that's a situation, as you asked, like what industries, like there are these unique little niche industries that all of a sudden got an accelerant from COVID, and now they continue to fly. So,
Thank you, Bobby.
yeah, you got it. Other questions? Awesome. Well, oh, sorry. Yeah, go ahead. Oh, we'll wait for the microphone.
So currently we are working on 3 verticals. Last year we have started in India, and this is all related to hydrogen. So we are currently supplying hydrogen to many industries. We are into collaboration. We are turning into some collaboration with some US-based company, which is supplying the hydrogen electrolyzer for NASA. So they are very much interested to collaborate with us in order to have the scaling of that electrolyzer and supplying it to Indian industries.
Sure.
Now, the very difficult part for us is, they are asking for some ESG details from us, and we are not into that as of now. The difficult part here is since we don't have any data to prove the ESG capability of us, but they have that tendency to check it. So what's your perspective, how to deal with that situation? And there are some other investors, some private investors as well, who are looking for such data, but India is still little lagging on that.
Sure. And so I didn't catch the acronym you said. Did you say ESG?
Yeah, so that's environmental social governance.
Oh, environmental social governance. Okay, got it. Yeah, that's an interesting topic. And so I teach a class on social entrepreneurship. So this is something that I'm extremely passionate about, right? So what's fascinating, and tying back to M&A and valuations, this is now becoming a question that is asked more and more of a lot of different organizations. Unfortunately, I don't know your space. I could tell that industry is very technical, and so I can't really comment on exactly what would be needed there. I can speak more generally though, is every organization now has to have some perspective on their social impact. And that perspective can be something as basic, and this is going to sound silly, as we recycle, right? All the way to we have a business model that actively contributes to society. And what the research very clearly shows is the further along on the spectrum that you are, the happier your team is, the happier your clients are, and frankly, the more money you end up making, right? And so having a perspective on that is critical. And so the guidance that I would give you, not knowing your industry at all, is that I would approach experts on this topic, right? Go to some of the bigger players in the space or find the right advisor to help you guide through that, because especially if you're selling into governments, and we've worked with clients that have done that, it's extremely complex. I mean, on the continuum, you've got, direct to consumer, the broad market on one end of the spectrum. And the reality is they're often very unsophisticated. So you don't have to have the most tight and clean marketing. You could sell a product. And then you have, as an example, healthcare. Then you have academia. And then you have the government all the way at the end. So I do not envy what you have to do. And certainly if you want to talk after, if there's any connections or people in my network that could help, I'd be happy to, but I just don't know that space. So. Great, thank you. Awesome. Other comments, questions? Excellent. Well, sure, Yuvraj.
Bobby, you were telling about inbound and outbound of investments from US. Like it was from $500 million from it was outbound,
yeah.
And the rest inbound was only for 430 million. So when the investors are looking, when they're pushing the funds, the finance is going outside US, what are they looking for?
Yeah, great question. And what I'd say is in the last 2 years, I've seen more US-based investment firms start offices around the world than I've ever seen in the past. And it's for the reason that I mentioned earlier, is people are looking to deploy capital. If they can't find investments in the US, they will look elsewhere. And so now to answer your question on what they're looking for, they're actually looking for all the same stuff. And if anything, they're looking a little bit closer than they would in the US. Now the reality is, one of the concepts in mergers and acquisitions that always is top of mind to me is that the seller has access to asymmetric information. So I'm going to say that again. The seller has access to asymmetric information. So what that means is the seller always knows more than the buyer, always. The seller knows where all the skeletons are buried. And I don't usually say the word always, but I'm going to say the word always. The seller always knows more. They know all the issues with their company. They know all the challenges. They know that their head of sales is about to quit and that the buyer is about to be screwed because the head of sales is about to quit. Now, the buyer may try to construct a scenario where the seller has to hit certain revenue targets, right? So there's ways to mitigate this, but the seller always knows more than the buyer. So if you think about an investor that wants to, as an example, invest in India and they're doing it for the first time, you can imagine that's a very dangerous proposition because they know very little about the culture, they know very little about a lot of things related to it. So typically in those scenarios, you'll have someone that they call boots on the ground that has experience in that local market, and they'll build out that market. So that's the long answer. The short answer to your question is they will look traditionally at almost all the same things that they would look for in the US, they look for in these different markets. Now, as an example, we're all aware the middle class in India is huge, right? It's larger than most countries. So there are investment firms that are just actively looking at companies that could leverage the products into that middle class, right? So there's different what are called investment theses, right? That are executed on based on what companies are looking for. But ultimately, the foundational aspects of what they're looking for are the same.
That's great, thank you.
Yep.
But if, apart from an investor, if a company is looking at some mergers or acquisitions outside US, so in that case, so are they just gonna invest, or they're gonna acquire the business for some instance?
Okay, got it. So you're asking the difference between a strategic investment and a full acquisition? Got it, okay. So this is an interesting one too, because the example I gave with the software as a service business, that was valued over $100 million, that was a strategic investment. So they took on about $10 million in capital, so roughly 10% of the valuation of the company, they took on as investment. That's actually an incredibly risky proposition for the investors, because now that company has to continue to grow, right? And so from typically valuations for an investment, strategic investment, are higher than valuations for a full-on acquisition, because the investor is willing to take on more or less risk depending on which type it is, right? So overall, when entities are looking, and are you asking, by the way, from the perspective of the company taking on investment, or the perspective of the company giving investment?
If the company is gonna invest, or if they're gonna acquire, what will be their strategic
The difference.
Yeah.
Okay, got it. Okay, this makes sense. So typically, you would acquire the full company if you believe that the value has already been maximized. So in other words, how do I describe this? If you think the founder is critical, or the founding team is critical to continue the growth of the business, and that there's additional opportunity to grow the business with that founding team, then you may take a strategic investment. So you'll only take part of the company. But if you think that the value's already been maximized by that founding team, and that it's ready for the next stage of growth that doesn't include that founding team, then traditionally you're going to buy the entire company. It's really as simple as that. Great. Awesome. Great. Thank you, everyone. Really appreciate it.
I hope there are no more questions which are unanswered. Maybe we'll take one more if at all there is one remaining. I think we pretty much had all answered. So thank you so much, Bobby, for that lovely talk. Because there's always a fear of dealing with a professor of finance that he'll probably bore you to death with numbers. But I'm glad that it don't happen today. In fact, he had stories to share of companies which have been getting valuations at 100x. These are fascinating stories. I mean, you don't get to hear of having people who can talk on such things, and a lot of key takeaways as well. I think there are a couple of gems that came from his talk. One is always the thing that time kills the deal. So I mean, this is if we literally translate it to something like a Gujarati version of this, it always says Lakshmi Chanlo karvaave tyare Rana Joai. That's what literally say when goddess of prosperity comes to you, you don't go and say wait for some time. So that pretty much works well. The other one, of course, he said is that in private equity and valuations, eventually everything regresses to the mean. So I think this holds good when you're looking at your investments as well, be it in stock markets and anything else. Broadly everything, if you think a particular company is overvalued, undervalued, please know that eventually things will likely move towards mean. And of course, he said lastly that seller always has access to asymmetric information. So these are key great takeaways. Apart from that, some lovely stories and in the hindsight, what leads to inflated valuations, perhaps a lot of access to the capital with the private equity players, and so much more. So thank you so much on this. I think it was an enlightening evening on finance, mergers and acquisitions, and perspectives from the US. We wish you well with the offices in India and Ahmedabad as well, Bobby, and thank you so much once again. Thank you all of you for being here with us today evening, and we look forward to always having you at AMA. There's a quick feedback form if you can spend a minute or more and just fill that up. It'll always be helpful for us at AMA to design more such programs. Thank you so much.